What does your retirement look like? Are you confident you're on the right track? Navigating fluctuating markets alone can be confusing. Stocks, bonds, annuities, 401ks, and IRAs. Get ready to be informed and empowered by financial experts Joe Anderson and Alan Clopine. They'll simplify the process and give you the tools and strategies you need to map out the retirement you're dreaming of. Put their decades of experience to work for you. From Social Security to tax planning, they'll take the stress out of investing in your future. On Your Money, Your Wealth.
Hey, let me ask you a question. Do you think you're in the top 20% of all income earners in the States here? Someone thinks you are. Potentially stick around and we will fill you in on who's the top 20% and who's the 1%ers of income wage earners. We're going to take the sting out of taxes today, folks, so you want to stick around. Welcome. Show's called Your Money, Your Wealth. My name's Joe Anderson. Big Al is sitting right over there. We both work for a great company called, boom, Pure Financial Advisors. When you look at income, right, that's how we're taxed. And the IRS says the top 20% of all income earners, you make $133,000 if you're single, 130 grand if you're married, 196. So you make more than 80% of all of the U.S. population. So how do you save a little bit of money? Because that's who the IRS is after. That's what we're going to get into today. That is today's Financial Focus. Here, let me break down the numbers for you. This is from the Tax Policy Center. So you're in the top 80 percentile, like I said before, if you make $134,000. What is their fair share of tax? They're paying about 10% of all tax. If I look at here, if you make $180,000 to $600,000, you're paying about almost 30% of all tax. Now here's the 1%ers. If you make more than $116,000, these individuals, that's Big Al, by the way, right? He's paying about 50% of all taxpayers. Here's the problem when you look at tax planning, because half of the population doesn't pay tax at all. So when you think about I'll be in a lower tax bracket in retirement, that's for the masses. For a lot of individuals that have saved a little bit of money, you are paying the majority of the taxes. So we're going to figure out how to save some money in taxes. Let's bring in the big man right now, Big Al Clopine.
Taking the sting out of income taxes for high wage earners, and I've got a tip for you. It's not just high wage earners, it's really virtually anybody can benefit from these strategies. We're going to start off with retirement plans. Make sure that you're getting as much money as possible into a retirement plan to save some taxes. We got some charitable strategies to go over with you. Some of you have real estate that you'd like to sell, but there's a big gain. We'll give you some great strategies there. Of course, Roth Conversions. It wouldn't be our show unless we talked about Roth Conversions. And then finally, we want to get a little bit into tax loss harvesting. So, Joe, what could be a better topic for Sunday morning than income tax?
You know, I mean, there's a lot of different strategies, and we're going to get, I guess, start somewhat common. I think a lot of you already have a retirement plan. So the first thing that you want to do to save a little bit of money in taxes is try to maximize as much as you possibly can into these retirement accounts. 401k plans, SEP plans, simple plans, 403bs, 457s, you name it. This is a really good starting point, I think, for a lot of people to say, hey, you know what, can I save a little bit of extra? That's, I think, is the first place to start.
Well, it is, Joe. And so I think what you have to realize, if you're employed, if you have some earned income, is do you have an employer plan or not? And some of you don't. So you're kind of stuck with a regular IRA, traditional Roth, a traditional IRA and Roth, sorry, or just a regular savings account. But if you have a 401k or a 403b or a 457, you can save a lot more in. And those numbers are $5,500 for IRAs and Roth IRAs, $18,500 for 401ks, 403bs, 457s. Interestingly, Joe, 457s, if you're a government employee, certain government employees can actually do a 403b and a 457.
Right. If you're a school teacher out there, right, just know that you can double up 403b and 457, so you can double dip on those plans, which is pretty cool. Now, if you are self-employed, now taking a look at, you can really maximize some of these plans here depending on what type of plan that you want to set up. And we talked a little bit about this last week, but you have, depending on the level of employees that you have, if you're a sole prop or if you have a large organization, then you want to start getting in to see what a plan's appropriate.
Yeah, I think so, Joe. And really, when you think about this, when you have your own small business and you've got employees, then you have to really start including the employees as well. So we're going to show you 4 different examples. The first one people think about is a SEP IRA, Simplified Employer Pension Plan. And we just have a little example here. Let's say you make $100,000 net profit in your business, and in each of these examples, you're under 50. How much can you put away in a SEP IRA? It's about $18,500, give or take, right in that range. Now, you may want to look at a simple IRA. That's another choice, Joe. That's about $18,500. That's pretty much the same. The SEP IRA, though, allows you to put a little bit more in if you make more income.
Let's go to Charitable Strategies, because there's some really cool things that people can do. We're approaching the end of the year, and then you're looking at, hey, you know what? Maybe I have a very large income tax year. What are some of the things that people can do as a donor advised fund, which I don't think a lot of people are familiar with?
Yeah, Joe, I would say that's one of the strategies that when we talk to people about, they get very excited. I'd say most people we do talk to don't know and understand about this strategy. A donor advised fund is simply an account that you set up generally at a brokerage company like TD Ameritrade or Schwab or one of those. So it's an account you set up, you put money into that account, it's for charity. You can't take the money back. It's a one-way street, so be careful of that. But it's for charity. And then you get a tax deduction in the year that you actually put the money in. And Joe, so it's like future year contributions. You can actually take the contribution right now if you put money into this account.
Right. For example, let's say if you have a $10,000 gift that you give to an organization, and then you have a fairly large tax year. Well, you can bunch those gifts up and say, you know what, I have maybe $50,000 that I want to give to charity over the next 5 years, but I could really use a large tax deduction this year. In the next future years, maybe I'm not even going to take the deduction because my standard deduction is too high. So you can bunch all of those contributions up in 1 year. You make the contribution in the donor advised fund, you take that $50,000 tax deduction this year, then you can dole out that money throughout depending on what you want to do with it. So it's a really good strategy, especially when you're looking at end of year type tax stuff, is that maybe at stock options, a sell of a business, real estate, whatever. This is a good way to jumpstart maybe a deduction that you might not have thought of.
Yeah, and I would say in a lot of cases, we talk to folks that are either have a high income year or maybe they're just about to retire. And so they're in a higher income year this year than they're going to be. But they're planning on making contributions throughout their retirement. And it's like, well, I'll be in a lower tax bracket then, so it may not benefit me as much. Now, you can actually take that deduction right now. You put whatever, 20, 30, 40, 50,000, 100,000, whatever you want to put in, doesn't really matter. You get the tax deduction this year while you're in a tax bracket, and you dole those funds out slowly over time.
I just said that. That's good. We're just giving you dual doses here.
It's that important.
It's that we got to just keep telling you. What kind of stock or what kind of investment should you put this thing, Big Al?
Well,
should you put cash?
That's another good point. You can't put cash. But here's the thing. So you put $10,000 cash in and you get a $10,000 deduction. But better yet, what if you have stock outside of a retirement plan, for example? Maybe you got a stock that's worth $10,000 that you paid $1,000 for it. You give that to the donor advised fund. You do get a $10,000 tax deduction, but guess what? You did not have to pay taxes on that $9,000 gain. So that's really the best way to do this if you have appreciated stock.
You know, we got to take a short break. When we get back from the break, Big Al is going to talk about real estate, one of his passions. So if you have highly appreciated real estate, you're looking to sell, but you don't want to pay the taxes, we're going to go through 2 or 3 pretty cool strategies that can reduce or almost eliminate all of those tax burden that you don't have to worry about. If you want more information, we do have a tax guide this week. So everything that we're talking about on this show, end of year tax planning ideas, you can go to our website, yourmoneyyourwealth.com, click on the special offer. The tax guide is our gift to you today for watching our wonderful show. We'll be right back. Don't go anywhere. We're just getting started. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here and Big Al Clopine. We're talking about saving money in taxes. Stick around for this segment. We're going to get into some pretty cool things if you have highly appreciated assets such as real estate. But before we dive into any of that, let's see how you did on the true-false question.
A couple can give away $30,000 a year to as many people as they like without paying any gift taxes. And that's a true statement. And a lot of people sort of don't really understand what this means. In other words, you could give $15,000 to a person. If you're married, husband and wife can give $15,000 each. And then you avoid gift tax. It's not a tax deduction, but you can give the assets to your kids, your grandkids without any tax impact.
$30,000, that's a lot of money, Big Al.
It is, and if it's husband and wife and your son or daughter is married, then you could actually do $60,000 because there's 4 different people.
Yeah, that's the annual exclusion, and that keeps going up a little bit. It adjusts for inflation.
It does.
I still, people think it's like $8,000, but
yeah,
it's a little bit more than that. It's about double
this year.
It's about double that. Hey, let's dive into another topic here, real estate. We haven't really talked about real estate much on this show, and a lot of you have highly appreciated real estate. I know 2008 just seems like yesterday, but it was 10 years ago, and then now a lot of the property values have come back, and some of you might not want to sell because of the tax burden. Big Al, let's break some stuff down here to look at, first of all, an outright sale. What should people do if they have a highly appreciated asset? And, if I look at this example, this real simple example, I probably won't want to sell it either.
Yeah, that's the problem. A lot of people like to invest in real estate because it does tend to grow over time, particularly on the coast, like we're in San Diego, for example. But this is why people don't necessarily want to sell. And there's a lot of numbers on here. Let me break it down real quickly. So if you're selling your property for $700,000, so that's your sales price. Now, what did you buy it for? You bought it for a couple $100,000. But you've been depreciating it. Depreciating it means that you're writing off a piece of the property each and every year. So let's say $150,000 is your depreciation, so your cost basis, what the accountants call it, is $50,000. So the difference between these two is your gain. Your gain is $650,000, and your federal tax in the highest brackets would be about $155,000. Now, if you live in California, you might add another $80,000 or even $90,000 on top of that. So you add these two together, Joe, you get close to $250,000. You don't really want to sell.
Right. It's like, okay, well, here, I'll just hold on to that property, because there are strategies that you can do, which a lot of you do. You just hold on to it until you die, right? Because there's something that's called a step up in tax basis. So if you pass away, your heirs can receive that asset, sell it the next day, and pay 0 tax. But let's say if you need additional cash flow, let's get into 2 other strategies. Maybe that rental property is not producing the cash that you want, or that you're getting older and you don't want to maintain it. There's a 1031 exchange, and then there's also something that's called a tax-exempt trust, or maybe a charitable trust. So Big Al, let's break down what a 1031 exchange is.
Yeah, let's start with that. And the reason you might want to do that, now you're exchanging from one property to another property, but maybe you're doing that because you want a property that has better cash flow for retirement. So let's talk about the requirements. So first of all, it has to be the same taxpayer selling and buying the property. Seems obvious, but sometimes it's in a certain entity and you want to buy it yourself. So it has to be same entity. You have to have like-kind property, which is pretty generous. It just needs to be a rental. You've got, when you sell your property, you have 45 days to identify up to 3 replacement properties, and then you have 6 months after close of escrow to actually buy the replacement property. It needs to be greater or equal in price. And if you do all those things, you take the gain of the old property and defer it into the new one and pay no current tax.
And so I think why people would do this is that, all right, well, here, I have this property. It's not really performing all that great. And then so what do? Maybe I find an apartment building that has really good cash flow. So I take this one unit and then I exchange up. Now, what happens if you exchange down, right? So you go to a property that's $700,000, you exchange it, you don't pay any tax, but the property's worth $600,000.
Well, that's a good point. And so in that particular case, to use my example, then $100,000 would be taxable and the rest of the gain would be deferred. So it's a partial exchange is what happens in that case, Joe.
So here's another cool strategy. Alan's going to write this out on the whiteboard, but it's called a tax-exempt trust or a charitable trust. So maybe you don't want to exchange the property at all. You're like, you know what? I'm done with real estate. I just want to sell it. I want to get rid of it, and I want to have more liquidity, and I want income. So there's something that's called a tax-exempt trust. Al, why don't we illustrate what the heck that is?
Yeah, Joe, and I think this is an important one. I think a lot of people, once they learn about this, they get real excited about it. So let me explain. I'll try to do it on a very simple level. So you set set up a tax-exempt trust. So I'm just going to call this tax-exempt trust. And you've got your property over here. We'll say property. You contribute that property over to the trust. Now the trust owns it. And when the trust sells it, there's no tax to pay because it's a tax-exempt trust. So you have the entire proceeds here without taxation. Now what you get is a lifetime earnings stream year after year. You get payouts from this trust. And the payouts are part income, part principal, part growth of the trust. So the reason it's tax exempt is that when you pass away, roughly 10% of what's in this trust goes to charity. That's how you get it to be tax exempt. But if you think about it, if you're in a 30% bracket or higher, if you're saving a 30% tax rate now in exchange for giving 10% away later. Now, I know I've oversimplified that, but this works for a lot of people because you get to sell the asset now. You do pay taxes on these distributions, but generally at capital gain rates, and it's a great way to create retirement income for those of you that have a lot of equity in real estate.
Yeah, we would highly suggest you visit a highly qualified estate planning attorney to do any of that advanced strategy instead of taking a picture of that red little snapshot and go, Big Al told me to do this and I don't pay any tax and I get 10, well, something like that. Basically, what you want to figure out in a retirement income strategy is to have a little bit more balance in your overall assets. So if you want to sell real estate, how do you sell that to reduce the overall tax? You can exchange or put it into a charitable trust. Then you look at other asset classes. We talk about Roth IRAs quite a bit, and we believe that the next few years is the biggest opportunity for a lot of you to do Roth IRA conversions because of the recent tax law change. Because Al, if you look at it right now, $315,000 is the top of the 24% tax bracket. Last year, if you made that kind of dough, you were paying alternative minimum tax. You lost all sorts of exemptions. I mean, you're probably in the effective rate of what, 35 plus state, 45? It's a huge tax savings for people that are making a lot more money that they never looked at a conversion before because it's like, that's not going to make any sense. We believe it probably makes more sense than ever.
I think so too. And as you said, top of the 24% tax bracket, married taxpayer, $315,000 of taxable income, single, $157,500. And I can tell you, I completely agree with you, Joe, because most folks that were married that had that kind of income, at least in California and high tax states, were subject to alternative minimum tax. And their marginal rate because of alt-min was 35%. So if you tried to do a conversion last year with this kind of income, you paid 35%. This year, you're paying 24%. That's an 11% savings. This is definitely a year and the next several years where you want to be considering Roth conversions.
Hey, we got to take a short break. When we get back, we're going to flip the show to the experts. So we're going to bring a couple more people in to answer your email questions. But don't forget to get our tax guide. Go to yourmoneyyourwealth.com and click on the special offer for your free tax guide. Just download it right there on your computer. Don't go anywhere. We'll be right back to wrap up the show. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here with Big Al Clopine. Thanks a lot for hanging out with us. Hopefully you're enjoying the show this far. We are talking about taking the sting out of taxes. I don't know if you've ever had a bee sting. Some of you, it just brushes off. With me, it's like I got to go directly to the hospital. So the stings, I guess, matter with who you are. Anyway, let's go to the true-false question.
Section 199A of the new Tax Cuts and Jobs Act is a tax credit and not a deduction. Well, that's definitely false. It's a deduction. It's 20% of your net business income as a small business. You may be able to take that as a deduction to reduce your taxes, but Joe, it's not a credit.
We're approaching the end of the year. If you're a small business owner, I highly recommend that you visit someone that understands the tax code because there's a lot of potential tax savings if you are a small business owner. And speaking of more tax savings for individuals or for business owners, there's something that's called tax loss harvesting. And so this is a unique strategy that you can use if you have equities or mutual funds, anything like that go up and down in value. Tax loss harvesting, Al, this is a pretty cool strategy that I think a lot of people are confused on.
So Joe, you're right. Tax loss harvesting is a really cool strategy. So when you buy a stock or a mutual fund, you hope it goes up and up and up and up, and that's not always the case because sometimes your investment goes down. When it goes down, we actually suggest that you sell it to create a tax loss. Not that you enjoy losing money, but you create a tax loss. You buy something similar so that when the market does go back up, you still have your investment integrity. In the meantime, you've created a tax loss, and that loss can be net against capital gains dollar for dollar. And Joe, this is where the confusion is. People think it's only $3,000.
Yeah, there's a few things here. Is that, all right, well, when you lose money, everyone told me, well, no, I'm not supposed to, I should buy more. Yes, we're not saying selling going to cash. That's not the point. It's like you sell mutual fund A, you buy mutual fund B. Something extremely similar. It can't be identical. So if you sell Coke at a loss, you can't buy it right back to create that loss. You could sell Coke and buy Pepsi, sell Home Depot and buy Lowe's, something like that. So you create that tax loss and you're still in the market. You're still in the stock market. So when the stock market does recover, you have that tax loss sitting on your tax return. So when you have future gains, that loss will offset that gain dollar for dollar. And like Al just said, it's like, all right, well, people think, well, if I have a $10,000 loss, I can only use $3,000 of it. Well, that's against ordinary income. That's not against capital gains. Those are two totally different taxes. And when you're looking at creating income in retirement, it's extremely powerful.
Well, it is because you can create some tax-free income from your non-retirement accounts that way.
Absolutely. You know what, Al? Let's go to Ask the Experts. Stick around because we're leaving and bringing a couple of other really good people in here.
Yeah, I was going to say, we're the experts. Are we the experts? How do I determine a good time for selling my lost positions in my stocks and mutual funds? Josh from Oceanside. Wow, perfectly timed question. So I'll just tell you, when the loss is meaningful enough for you to create a tax savings. I mean, if it goes down a couple dollars, forget about it. But if it goes down a few hundred or maybe 1,000 or two, then you might want to take that loss.
Next question. What do we got?
Cindy from Encinitas writes, my husband and I have invested heavily in antiques and artwork. How do we account for those items in our plan for retirement? Ooh, that's an interesting question. What do you think, Joe?
I don't think you do. I mean, if you have a bunch of antiques and artwork, you should be pretty set for retirement.
Yeah.
Right? I don't know.
Well, I can tell you, so my dad loves gold coins, right? And he's invested in that. I wouldn't say heavily, but he invested in that enough to try to make this meaningful for him. And he found that when he bought gold coins, he paid a premium to buy it, and he got a discount when he sold it. So just be aware when you're buying kind of rare coins or antiques or things like this, artwork, you may be paying a premium and selling it at a discount. So it's very difficult.
So where would you go? Right, I got a stamp collection, Al.
Yeah.
Right?
I never knew that.
I don't. I'm totally making this up. So let's say if I did have a rare stamp. Yeah. I mean, where do people go to, even the Antique Roadshow?
So it's a great question. I mean, I don't know that much about stamps. I know coins, you go to a coin shop, but they have to make money too, right? That's why they sell at a premium and buy at a discount. So I just don't think you may make money on this kind of thing and maybe you get lucky, but it's hard to count that as a significant retirement asset.
Yeah, I don't know. I guess if you have a lot of art, right, that you've spent a lot of money on, right, you probably would go back to the art dealer.
Yeah, I suppose.
You're probably in those circles.
And if I painted that art myself, I would.
Yes, the problem is with anything, with questions like this, is that I think people are ill prepared for retirement. And so they're scrapping and looking for everything possible to say, okay, well, you know what? This art is worth, $20,000, where in their mind, it's probably worth $20,000 because you've looked at that piece of art for the last 20 years. But it's only worth what someone else is willing to buy. So you have to be careful of looking at asset classes of all kind, coins, artwork, antiques, anything that's illiquid. You have to be careful when you're planning that for your overall retirement, because if it's not traded, you have no idea what the price is, and then that's where it can get fairly dangerous, I think.
Yeah, and I think, Joe, I might add that if you have these kinds of assets and they are significant for you, just go ahead and discount them rather heavily for your own planning, because you may not get what you think you want out of it.
Hey, so what the heck did we learn today, folks? Well, we learned a lot of things. We learned, hey, why don't you max out your overall retirement plan? Try as hard as you can to max out those 401k plans, those IRAs, those Roths. Then we talked a little bit about charity. There's different charity programs that you can get into that can save you first. First give to the charities of your choice, but then secondary, you know what? You can save a little bit of money in tax. Then we got into real estate, disposition planning. Can you sell that real estate and avoid taxes? 1031 exchange, charitable trust. Then we talked about tax loss harvesting, and I guess to wrap it up in a bow, if you have a stamp collection, Big Al is in the market. We're out of here. For Big Al Clopine, I'm Joe Anderson. Hopefully you enjoyed the show because we just finished another wonderful episode of Your Money or Wealth. Have a wonderful weekend, everyone.